Hey, stock, Forex, and crypto traders. Are you feeling fed up with switching between trading strategies and feeling like none of them give you the edge you need? Welcome to Fibonacci Decoded, Beyond the Golden Ratio. This is the #1 most requested video for my channel, and I'm happy to actually put everything together to bring it to you. So that's what we're going to do in this video. In today's video, I'll share with you my favorite technical analysis tools, my go-to for stocks, Forex, and crypto trading. And it's helped me boost my success on the charts regardless of the strategy that I'm using. Like you, I've tried out a ton of different strategies, but found that this tool works better for me overall when I add it to whatever strategy I'm using. In today's video, I'll guide you through all the ins and outs of the Fibonacci Retracement tool. Whether you're experiencing a high number of losses or you just want to boost your win rate a little bit, this tool is going to enhance your technical analysis skills, leading to stronger entries and greater confidence in your trading. Here's what you'll learn in this video: the theory behind the Fibonacci Retracement tool, what the retracement tool is used for, how to draw the Fibonacci Retracement tool properly, what all of the default fib zones represent, and other tools that can be used with the Fibonacci Retracement tool for stronger confirmations before your entries. Now, feel free to leave a comment to let me know what your favorite part is. If you're in the mood for a health challenge during this video, pause here, grab your favorite snack, your healthy snack, and take a bite every time I say fib zone. If you need to drink more water, then I need you to take a sip every time I say fib zone. So far, I've only said it 3 times. Now, by the end of this video, you'll have a better understanding of the Fibonacci Retracement tool, and you'll be armed with the knowledge that you need to make better and more informed decisions in the market. Now, disclaimer time. None of the information in this video should be considered financial advice. I don't give that out. I don't give out financial advice. The information in this video and all of my videos is simply an expression of my own opinions and are for entertainment purposes only. Now, all decisions that you make are your own. But as always, if you're here, you're interested, so let's get into it. Imagine the foreign exchange market where traders constantly battle over currency values based on economic news, interest rates, and global events. This complex interaction can lead to trends where the value of one currency strengthens against another one. But within these trends, there are temporary pauses or pullbacks called retracements. These retracements can happen for a couple of reasons. When a currency strengthens, some traders might take profits by selling it. On the other hand, during a weakened trend, traders who short sold a currency might be pressured to buy it back, causing a temporary price increase. The theory behind Fibonacci retracements is that price action might find temporary support or resistance at specific fib zones. In simpler terms, price might find temporary pauses or reversals at these fib zones, most notably around the major ratios of 382 and 618. Some traders use these fib zones as potential entry or exit points for their trades. Here's where Fibonacci retracements come in. They're based on the Fibonacci sequence, a famous series of numbers where each number is the sum of the 2 before it. Interestingly, the Fibonacci sequence incorporates the golden ratio, or 6:1.8, which is a naturally occurring proportion found throughout nature. Traders use the Fibonacci retracement tool derived from this sequence to identify these potential areas of support and resistance within a trending market. The key takeaway is that Fibonacci retracements are just technical analysis tools. They can help traders identify areas where the trend might pause, but they are not financial prediction tools. there's no guaranteed outcome, and economic forces can still drive price in unexpected ways. That's why I will be telling you guys throughout this video that this tool does need to be used with other tools to create strong analysis, okay? So if I haven't already told you guys, you might want to pause the video and grab pen and paper, or just be prepared to maybe rewatch the video and take some notes. So grab your fib notebooks, but let's get into what the retracement tool is used for. Now, the fib retracement tool is used to identify potential support and resistance levels, most notably around major ratios like 38.2% and 61.8%. Now, when the market is trending, these retracement levels act as support zones during downtrends. Okay, so for our downtrend, I went ahead and clearly marked up the areas for each fib zone. So you can see from 0 to 23 is blue, from 23 to 38 is white, from 38 to 50 is white. Okay, y'all get it. So for support, this is a price level where a downtrend tends to pause or stall and bounce back up. It reflects an area where demand for an asset increases, overpowering the selling pressure and pushing the price back up. So every time price got to 382, we got a little push, got a little push, got a little push. So y'all can see it on the charts. Or resistance zones during an uptrend where price might drop below the level due to selling pressure. Now here's an example of what resistance looks like during an uptrend. This is a price level where an uptrend tends to stall or reverse or fall back down. It indicates a zone where supply for an asset overwhelms buying interest, causing price to retreat. So every time we got to that 382 area again, buyers could not keep that momentum, and eventually it fell off and turned into selling pressure. Now, traders can use these retracement levels or fib zones as potential entry and exit points for their trades. So let me give you an example. In a downtrend, a trader might look to buy near support levels around, let's say, 38.2 retracement, if they believe that price is going to bounce back up. On the other hand, they might exit a sell position near a resistance level like 61.8% if they think that a reversal might be on the horizon. Now, when you're using the fib retracement tool, there are 3 important things to consider. It's not a guarantee. Fibonacci retracement levels are not guaranteed to hold as support or resistance. They simply suggest areas of interest, and price action confirmation is crucial before making any trades. The accuracy of these levels also depends on your chosen anchor points, so the highs and the lows that you choose to start and stop your fib on. So make sure your anchor points represent significant swings in price, significant highs, significant lows, unless of course you're using those smaller swings because you're trading on a smaller time frame, something like a 15-minute, a 5-minute, or a 1-minute chart. Confirmation is needed to strengthen the validity of potential support or resistance zones, or to strengthen the validity of the fib zones that you've marked up. Look for confirmations from other technical indicators. And what I mean is, look for information that's in line with the fib by using things like price action or candle patterns. And I get that candle patterns can be tricky. So you can also use things like the information from a trend line, or relative strength index tools, or tools that highlight divergences in the market that signal strengthening or weakening in trends. Now, this is not an all-inclusive list, but these are the things that I use. The third thing to consider is the psychological aspect. Some people argue that Fibonacci retracement levels hold importance because traders themselves are aware of those zones, potentially creating self-fulfilled prophecies for support and resistance zones. And I completely understand that too, because if you're marking up a chart and you see where a potential reversal could happen, you may be logically thinking, and you might set a take profit or you might set an entry. So I can understand the psychological aspect too. But overall, the Fibonacci Retracement tool is a popular technical analysis tool, but it should be used cautiously and with other strategies or other tools for a more well-rounded trading approach. You should be using it with other tools. Now, if you do want some additional information on divergence and RSI, there's an entire video already in my playlist, and I'll link it up top for you, okay? So let's talk about how to draw the Fibonacci Retracement tool. We're going to talk about it, and then we're going to do it. So to draw the Fibonacci Retracement tool, starting from a significant high or low. So when you draw the tool, you start from a significant high for a downtrend or a significant low for an uptrend with the first click. So uptrend, significant, we're going to start. Told y'all I like to zoom in and make sure that we're on point, literally on point. So this is our starting point for our fib. The second click represents the opposite extreme. It's a significant low for a downtrend or high on an uptrend. The fib retracement tool helps identify potential support and resistance fib zones based on the Fibonacci sequence, which is just a mathematical series of specific ratios. As soon as you define the second point, charting tools like TradingView will automatically draw the Fibonacci retracement lines on your chart for you, but you do need to be consistent when you do this. What I mean when I say you need to be consistent is that if you use wicks, you need to always use wicks. If you use bodies, you need to always use bodies. So the reason why is so that you can have consistent information across your analysis. I personally have chosen to use wicks. The reason why I've used wicks for the entire time I've been doing this is because I mark up on higher time frames. That's how I was taught. So if I'm doing a markup on a higher time frame, like a weekly, a daily, or a 4-hour, the information in the wicks on higher time frames converts to candles or bodies on lower time frames. So I don't want to miss any of that important information because I do top-down analysis. I do my analysis from the bigger, broader outlook for weeks and days, and then I enter on either a 1 hour or a 30-minute, depending upon how I feel or how the market is moving, so on and so forth. So wicks, if you're going to use them, always use them. If you're going to use bodies, always use bodies. There's no right or wrong answer to it. It's just how much information you want in your analysis, but that's how I do it. You do what you want. That's just my little tidbit. So I can give you guys a visual. I am using TradingView, and I like to use TradingView because it gives me a lot of information, a lot of different tools at my disposal. One of my favorite things is my little favorites bar. If you don't have one, if you haven't watched any of my TradingView videos where I show you how I created or how I put together all of the tools on TradingView to kind of suit my needs best and show you how to make a favorites bar and things like that, check out the playlist. There's an entire TradingView playlist in my channel. But there is something called GANs and Fibonacci tools. So you can open that. If you put a star next to it, it automatically populates in your favorites bar. My favorites are the retracement, extension, and time tools for Fibonacci. For this little example, I'm going to be using the fib retracement tool. And we are going to draw from wick to wick. If you are drawing from low to high, the rhyme that I was taught is that you are looking for a buy. If you draw from high to low, you're looking to see how low price will go, okay? I do choose to zoom in because I like to check for accuracy. I want to make sure that I am on the lowest bodied candle and then the longest wick of that candle. So that's what's done here. There should be equal candles at the tops and bottoms. That's not always the case because sometimes the market does do weird things, especially if there are any periods of time where charts and things reset for time switches for different sessions, but in most cases, you'll be able to see two equal candles at tops and bottoms. So go ahead and zoom out, then zoom in again at the top, because some people will be fooled by the sexy wicks. I call them sexy wicks. Like for people who like people with long legs, it's the wicks to get you. But this is the highest body or highest set of bodies, right? And this is the longest wick of the two. So I know my fib is in the right place. Now, let's get into, I guess, what all of you are waiting for is the explanation of all of the default zones and what they represent. First things first, we're going to start with 0. So starting with 0, 0 is our baseline, the starting point of the retracement. This level represents the initial price before the retracement begins. This level doesn't typically indicate a reversal or continuation on its own. Remember, fibs needs to be used with other tools. It's simply the starting point of the retracement. 0 says, hey, since you're starting from here, let's take a look and see what's going to happen next. Then we have the 23.6% zone. This fib zone is considered to be a shallow retracement, the shallowest retracement fib zone. While this zone can suggest a mild pullback in the trend, it's typically not indicative of a reversal. This is more of a continuation zone. Some traders view this fib zone as a potential area for continuation if the trend is strong. Some even view this fib zone as a potential area to add to an existing position or initiate a new trade entry in the direction of the trend. So next we have the 38.2% fib zone. This zone signifies a deeper retracement than the 23.6, but is still relatively shallow. Similar to the 23 fib zone, this zone may suggest a deeper pullback in the trend, but not necessarily a signal of a reversal. Traders look for confirmation of a continuation if price holds above this fib zone. It's a commonly watched fib zone for potential support and resistance. Traders may expect a bounce in the price at this zone if the trend is strong. Next, we have 50%. Now, I want to note that this fib zone is not derived from the Fibonacci sequence, but is included in the Fibonacci retracement analysis because of its significance in trading psychology. It represents a halfway retracement of the prior move. So this fib zone can indicate a potential reversal or continuation depending upon how price reacts to this zone when it gets there. This is a key area where traders watch for signals of like market sentiment shifting, meaning going from buying pressure to selling pressure or the other way, right? Traders often closely monitor this fib zone for potential reversals or continuations in the trend. Next, we have 61.8, also known as the golden ratio. This fib zone is considered one of the most important Fibonacci retracement fib zones. It's often viewed as a strong area of support or resistance, often considered a critical fib zone. The 61.8 zone suggests a significant retracement and can indicate either a potential reversal or continuation. A lot of traders closely monitor price action around this fib zone for confirmation of the trend direction. Traders often pay close attention to price action around this fib zone for potential trade opportunities for entries and exits. Next, we have the 786 fib zone, aka the Chrissy pips zone. This zone signifies a deeper retracement than the 61.8 fib zone and suggests a stronger pullback in the price trend. Now, this fib zone may signal a potential reversal if the price fails to hold above or below it, depending upon if you're in an uptrend or downtrend. Now, traders watch for signals of weakness or strengthening to determine the likelihood of a continuation or reversal. Some traders consider this fib zone as a warning sign that the trend may be weakening or reversing. Now, those of you who don't know, this is my favorite zone to trade, but it is my favorite zone to trade in the fall since the market does a lot of consolidation. This is really good for consolidation. Next, we have the 886 zone. This fib zone is less commonly used, but still holds significance for some traders. It represents an even deeper retracement than the 786 fib zone and may indicate a potential trend reversal if the price reaches this deep into the retracement. Okay, only if it gets this deep. Traders look for confirmation signals on other tools along with the 886 fib zone to assess whether the trend is likely to continue or reverse to enter trades accordingly or even exit trades. Now, the last zone, line I'm going to talk about is the 100% line. This line marks the end of a retracement and represents a complete retracement back to the initial price of the fib zone before the trend began. It's essentially a return to square one in terms of price movement. A complete retracement back to the initial price fib zone typically suggests a reversal. Price reaching a 100% line could be signaling the end of a current trend and potential of the beginning of a new one in the opposite direction. Traders watch for confirmation of a reversal pattern to enter trades accordingly or even exit trades here also. Now, you can customize the appearance of your tool in the settings, the lines, the labels. You can change whatever you want, okay? This is what my settings are on. If you want to use these, it's on the screen for you. The Fibonacci Retracement tool is most effective when used in conjunction with other technical indicators and price action confirmation tools. So remember, the accuracy of the retracement fib zones depends on your chosen anchor points. So your highs and your lows that you're using to start and stop your fib. And remember, consistency is key. If you're going to use wicks, always use wicks. If you're going to use bodies, always use bodies. Now, I keep saying other tools, right? So other tools that can be used with the Fibonacci retracement tool for stronger confirmations are things like trend line analysis. If you're not familiar with how to draw trend lines, I have an entire video on my channel for trend lines. The relative strength index or RSI can be used. Divergence can be used. I do have a video about divergence that also covers RSI. You can also use stuff that just overlaps with the Fibonacci levels or the zones in addition to those confirmation tools. These are just the ones that I typically use. Comment below if you would like a breakdown of some of the other tools that I use to go along with Fibonacci. Let me know. Hopefully, I've helped you get a better understanding of the theory behind the Fibonacci retracement tool, what the retracement tool is used for, how to draw the fib retracement tool, what each default fib zone represents, and what additional tools you can use with the fib retracement tool for stronger confirmations. Feel free to comment below and let me know if there's any clarification needed. If you found this video helpful, hit that like button. I mean, your likes do tell the algorithm that other people might find value in this video. Also, please share the video with somebody who might need the information. And don't forget to hit the subscribe button so you don't miss out on what's next. I think I'll do a video on, well, you know what? Let me know what other fib tools you guys might want to see a video on, because I do use more than the fib retracement tool. But until next time, I hope you're having an absolutely amazing morning, afternoon, or evening, wherever you are in the world. And I'll see you in the next video. Bye.